Welcome to Bloomberg ETF IQ. I'm Scarlett Fu. Katie Greifeld is off for the week. Let's get to the biggest stories right now in the more than $15 trillion global ETF industry. Treasuries and the dollar dropping after Moody's strips the U.S. government of its top credit rating due to the ballooning deficit and debt. Now, with concerns over American assets mounting, investors are pulling back their U.S. exposure, but how long will it last? We'll look at the flows. And in just moments, we'll discuss the impact and potential volatility with Kristy Akullian of BlackRock. But first, let's check in with Eric Balchunas of Bloomberg Intelligence, who is looking, as always, at the flows. Eric, what do you see?
Hey, Scarlett, thank you very much. This whole Sell America thing, in my opinion, just totally overblown. I've been saying it all year. The flows just don't show it. And today, the market's already basically back to even. So all that, and we're no real sell-off. Look at VU, $4.8 billion. This is a ridiculous number to add on to its year-to-date total, which is now $62 billion. That is 4 times more than any other ETF. There's never been a lead quite like this. VU is really making history here. And then you have the Qs, right? That's a perfect 1-2 punch because you got the Vanguard bid here, which is relentless. But then you got the trading crowd buying the Qs, and there's no more Mag 7 ETF than the Qs. TLT, this is like Fed betting. Be very careful here. We've seen a lot of money burn in this thing. This is mid caps, more Qs, and more S&P. So that's about as bullish as you can get on the inflows. Let's look at the outflows. And you will see a little bit of a chunk here. This is a big number out of SPY. So I will say maybe that is some of the trading crowd pulling back. Generally speaking, though, net inflows to equities. Now, gold, bill, and SGov, in my opinion, would all be bullish. You see flows coming out of this. Also, gold getting passed by IBIT. Gold and IBIT are kind of in a competition for the same store of value money, and IBIT now has double the flows of GLD this year, which is interesting. Now let's look at a big picture of where we are this year and the whole Sell America concept, because if you look at the flows, right, this year they're at $400 billion and change. So we're in May. Let's say we go to the end of July, we'll probably be around here, right? Already, by the end of July, we will have the 3rd best year on record in ETFs. And it's on pace to actually get up near there, which is last year's record, if not 2nd best year, considering the market's flat. And a lot of this money is going to stocks and bonds. Again, it's hard to see where anything is different here besides investors just buying stocks and bonds as usual, Scarlett.
All right, and we still have more than half the year to go as well. Eric, thank you so much. Joining us for our conversation now is Kristy Akullian. She is head of iShares investment strategy in the Americas at BlackRock. Kristy, it's always a pleasure speaking with you. I want to start with the big news of the weekend, of the day, and that is, of course, the Moody's downgrade. The Treasury Secretary Scott Bessent played it down, saying it's a lagging indicator, which, true enough, it is, given that Moody's was the last of the credit rating agencies to downgrade the U.S. But the reason given, the ballooning deficit and debt, is very much in the present and in the near future as well. So how are you thinking about the downgrade? What risks does it add to the market?
Yeah, great. Thanks for having me. It's nice to be back. Is this news? Certainly. Is this new? Not really. To your point, Scarlett, we've already had a split rating for U.S. government debt. And this was, this move from Moody's was widely anticipated as well. I think the most important implications of this news that we've got, and really if it just serves to augment the focus that I think the market already had on this, was really just around some of the risk that we see in the long end of the yield curve. So at BlackRock and as a team, we have been structurally underweight the long end of the yield curve for a while, with the expectation that there still needed to be more term premium baked in because of rising deficits, because of higher inflation expectations, and just higher U.S. Treasury issuance overall. So within portfolios and how we're talking about this to investors, it's similar to what we've been saying for the last year plus, really, is more caution on the long end, thinking beyond just duration in terms of diversification within a portfolio, and focusing more on income and the front and the belly of the curve for fixed income allocation. So things like BINC, our BlackRock Income ETF, make a lot of sense in this moment where you don't just want to rely on that long duration exposure for the ballast in your portfolio.
Yeah, let's stick to bonds here for a minute. If you look at AGG, which is the most popular bond ETF, it's yours, BND also. A lot of people use it for their 40 allocation. I know you have some different ones here, but NEAR in particular. But we also looked at SGov. It's in the top 5 of flows this year. Why not just use that and call it a day? Because you get about the same yield and you get no duration risk. Why even use AG ever again?
Yeah, existential question, really. The ag is still most people's benchmark. We do tend to think that right now the duration is a little bit longer than we would prefer to take in a portfolio. So we like adjusting around that. But yeah, we do like the short end of the yield curve. I think SGov does make sense. And then again, that focusing on the income component where you can actually increase yields a little bit by moving maybe away from just the ag portfolio and looking at some of the plus sectors beyond that, you maybe get a better trade-off in risk and reward between yields and the risk, not only from duration, but from credit risk as well that you're taking.
Leave it to Eric to continue to poke holes in ag, which is something he does consistently.
It's a theme, yeah.
The other story, the other angle here of the Moody's downgrade is that this is another sign of the de-dollarization that's taking place. The consensus view going forward is very much for the dollar to weaken further as well. So what does that mean for geographical allocations for U.S. investors versus, say, overseas investors?
Yeah, absolutely. And, I agree with Eric here, too. I think that there has been a little bit, too much hand-wringing probably about the concept of, the end of American exceptionalism. We haven't seen inflows that investors are moving away from U.S. equities in particular. I think that, if anything, the split that we see in terms of flows and positioning is more between U.S. retail investors and U.S. institutional investors, which have taken a very different track here. But I think that, from a global asset allocation perspective, we're going to continue to see international investors allocate to the U.S., but we maybe see more of an impulse to hedge some of that exposure as well, just because of the influence of the dollar. So I think that our hedged suite of products are interesting. And yeah, like I said, we've been talking to investors around the globe, and there is still a really strong impulse to continue to allocating to U.S. equities. I think that there's just more of an impulse to be a little bit more dynamic about how that happens. So either considering hedging or not, maybe thinking beyond just the broad benchmark. We've certainly seen, strong flows. I know we've talked about it before, but DYNF is our dynamic factor allocation fund. That's a good way to get core U.S. equity exposure that can rotate and be really nimble and dynamic as we are getting, continuous news flow this year, but to do so in that tax-efficient structure of an ETF that can result in sort of better after-tax outcomes for portfolios as well.
So what you're saying makes sense on paper, and I get it, right? All of this is about whether to Mag 7 or not, right? But if I look at the past month, right, the Mag 7 is up 23%. That's double the S&P, like 5 times USMV, and about 4 times Europe. And a lot of people were told not to buy Mag 7 a month ago. How do you explain that? Like, at some point, isn't it crying wolf? Shouldn't you just own the Mag 7 and just not look at your account for 10 years?
Certainly there's a benefit to not looking at your account too often. But yeah, when we look at the Mag 7, the performance recently has been very good, but still down relative to the rest of the market year to date. So if you thought about some of the broader plays and those broader applications coming into this year, those made sense. If you look at the relative richness of the Mag 7 versus the rest of the kind of 493 other names in the index right now, it's much lower than it has been. It's actually almost down to pre-pandemic lows in terms of just, again, that relative richness between Mag 7 and everything else. And so, one of the things that we've been paying a huge amount of attention to is earnings. And even though I think they almost got written off for Q1 because everybody thought that they were backwards looking and just from the before time, before some of the tariff announcements, what we've heard, and I think the starting point really matters, and what we heard from a lot of those companies, particularly the Mag 7 ones, is that they continue to invest CapEx. Their earnings continue to be really strong. So we do think that there is a pretty significant part in a portfolio for allocating to, the AI trade, not just the Mag 7, but as that moves sort of beyond hardware and into things like software as well. So, I think that the broadening out story holds true, but it is also a story of AI broadening out and how that is going to improve productivity more broadly. So something like the BlackRock AI ETF is an actively managed approach to be able to capture some of those themes as the market evolves, and certainly as we get more, earnings announcements even ongoing as well.
All right, Kristy, I really appreciate your joining us today. Kristy Akullian of BlackRock. She's the head of iShares investment strategy for the Americas. And of course, we do have some headlines crossing as well out of JP Morgan Chair and CEO Jamie Dimon. He is speaking right now at the firm's Investor Day, and he's made a number of comments. Most interestingly, he said he's personally not a buyer of credit today, and that he still thinks America's asset prices are, quote, kind of high. Having said that, I do believe in American exceptionalism. I am a patriot, says Jamie Dimon. And he also adds that he never believed Europe was as bad as people were saying. So we'll continue to keep an eye on these headlines from Jamie Dimon at their Investor Day. In the meantime, you can watch him right now on the Bloomberg terminal. Just type Live Go on the Bloomberg. This is ETF IQ.
Conversation. So I just want to thank the board for the effort they make for this company. And Daniel Pinto, what a great partner he's been all these years. Daniel.
This is Bloomberg ETF IQ. I'm Scarlett Fu. It's time for the ETF Brief, where we highlight stories and trends that caught my eye. And let's start overseas in Latin America. Billionaire investor Stanley Druckenmiller taking a win in Argentina. After steadily building a position in ARGT since early 2024, Druckenmiller's family office has trimmed its stake in the fund by a fifth in the first quarter. You can see here that ARGT has more than doubled over the past 2 years, trouncing the rest of EM, as represented by that red line, on bets that President Javier Milei will be able to turn around that economy. Is the race to zero on fees coming to an end? It turns out that the average fee for ETFs launched this year has climbed to 65 basis points, which is the highest ever. As the ETF industry matures, issuers are increasingly looking to launch higher margin products like actively managed funds to boost their profitability. And let's turn now to global investors' exposure to the U.S. The question, how much is the American exceptionalism trade coming to an end, especially after April 2nd? The answer, not at all in the U.S. and not really in Europe, where 80% and 51% of ETF assets, respectively, are allocated to the U.S. A different story, though, in Asia, that last set of bar charts, with only 11% of assets allocated to the U.S. So let's talk more about this with Athanasios Psarofagis of Bloomberg Intelligence. This was a great story because it really summarized a lot of the themes that we discussed, but we don't necessarily have a lot of data for, at least not until a couple of weeks later. That was a snapshot, and what it shows is that each region seems to have its own home bias, the U.S. and Asia. The Asia region only has about 11% allocated to the U.S., as we mentioned. So for a bull, that means there's room to increase, right?
Yeah, exactly. And what I thought was interesting about Asia is that they actually took up their U.S. allocations this year. One thing there's some regulatory caps in how much you can buy in the U.S., but I think if it was more of a freer market there, you probably would see more people buying the U.S. market. So they tend to just skew more towards their local stuff. But they did take up their allocation from last year. So I thought that was very interesting that they actually do have this big appetite for U.S. stocks.
Interesting, when you look at Europe, they definitely like to invest in the U.S., but this year, only I think 3 or 4% of the flows from Europeans there are coming to the U.S. I believe it's because Europe stocks are doing so much better this year, so they have something better than the U.S. for now. But you have a chart showing that when the gap between U.S. and Europe gets to this degree of a stretch, it typically bounces back and it's only short-lived, combined with the fact that the summer tends to be good for the U.S. as well.
Yeah, there's, the markets tend to outperform and underperform each other, but you're right, there was this very massive underperformance of the U.S. to Europe, and that does tend to snap back. So if you actually were buying during that period, you would have benefited from the U.S. rebound from this April. And then to Eric's point, it's not about a European summer thing, but it just tends to lag during the summer. Like, this is not a great time historically to rotate into European stocks. They tend to lag during the summer and then tend to do a little bit better to the U.S. More in the fall and winter. So it's just not a good time. Let's say if you wanted to rotate into Europe, there's not a lot of tailwind supporting that trade.
You might have missed that trade already, and you might want to hold off until the fall again before you move on. What do 3-month flows show when it comes to European investors and what they've been doing? Because we know that this time around, in the last couple of months, they've been pretty aggressive in at least reducing some of their overweight positions in U.S. stocks.
Yeah, they have. They've actually missed this whole rally from April 7th to now because they were actually taking it down this year. Mm-hmm. But it's also important to remember, when you look at the European market, most of their weights are still in the U.S. So if you want to get away from the U.S., it's going to be very hard because most of your returns, most of the assets are tied to it. But they were definitely the most aggressive aggressive in moving away from the U.S. compared to some of the other regions. But I think now they might regret it because they've missed this pretty aggressive rebound.
And I think that's why people stay in the U.S. We talk about this on the team all the time. It would be tough to get a U.S. investor to trade in Apple, Google, Tesla for Nestle and HSBC, no matter how good the returns are. And even a 17% gap isn't enough.
Yeah, I agree. And if you ever look through the S&P 500 and just go beyond Max 7, there are some all-star companies in there that we just forget about. And you're like, oh my God, that's in there too. And I feel like you don't get enough of that pop in the European market. It's a lot of banks and some older traditional industries. But yeah, and it's just really hard to pry money away from this U.S.
Yeah, you just think about the tech exposure. There's NVIDIA, there's Microsoft, there's Alphabet, and then you have, ST Microelectronics in the Netherlands. So it's not exactly like with like. All right. Thank you so much, Athanasios Psarofagis of Bloomberg Intelligence, with a look at Buy America, BYE America, to Buy America, BUY America. It's a little pun that we like to do here. All right, still ahead on ETF IQ, we drill down into a recently launched leverage fund with Markiewicz of Tradr ETFs next. This is Bloomberg. This is Bloomberg ETF IQ. I'm Scarlett Fu. It's time now for today's drill down, where we focus on one ETF. Eric, what do we have?
Scarlett, today we are bringing the heat. You know how I talk about the hot sauce ETFs. This is the hottest of the hot. You could call it a ghost pepper ETF or Carolina Reaper, whatever you want, but this thing will possibly burn the mouth, but the returns are very good too. If we look here, it's 2X D-Wave Computing, which is a, kind of a quantum computing stock, pretty small stock, but a very volatile stock. But it's only been out like a couple of weeks. You got $10 million. The fee is high, but nobody cares because they're trading it intraday and stuff. And it just came out. Let's look at the volatility of this thing for the first 10 days. These are all ETFs sorted by 10-day volatility. You can see QBTX, number 1 at 392, right? Number 2 is a 2X short Coinbase. Then we've got Rigetti Computing, another quantum computing. Now, I put MicroStrategy. You know how we were talking about the MicroStrategy leverage ETF was such a, hot sauce itself? It's only 100%. Then the S&P is 16. So this thing is 10 times or 25 times the S&P 500, Scarlett. So be very careful, but there's definitely an audience for this.
All right, good stuff, Eric. Joining us now to talk about this ETF, this volatile ETF, is Matt Markiewicz. He is head of product and capital markets at Tradr ETF. So, Eric gave it a couple of names. Ghost Pepper, I think, was what you said. Hottest of the hot sauce ones. In any case,
yeah.
All right. So this is a daily ETF, right? You're not meant to hold this over the duration. Talk us through how this performed in the days after April 2nd.
Well, we just launched it actually just over 2 weeks ago.
How would it have performed if the back test went back to?
I couldn't even imagine how it's definitely more than a habanero for sure, right, Eric? But it was all the quantum computing names were pretty volatile back then too, as people started selling risk in the wake of Liberation Day.
So I was looking at this, and it was a good experiment because, when MicroStrategy 2X came out, it was a huge hit. Huge. And I was like, well, maybe because it's just Bitcoin related, or is it the volatility? You've tested this for me. It was half the volatility because your ETF comes out. Nobody knows who D-Wave Computing is unless you analyze that industry. And the volume on your ETFs is pretty high. We're talking $10, $20 million for a new ETF. That's incredible. The returns, it returned 100% in one day, which I think is a record. But what's the risk? Let's say this stock goes down or they find out something consequential about the stock. Is there a potential for it to terminate like XIV? What's that? Could that look like?
Well, as Scarlett alluded to, it is a daily reset leverage ETF. So it gives you 2 times the performance of D-Wave quantum stock. There is a risk, Eric, if it was to go down over 50%, within the, close down 50%, that we would have to liquidate the ETF.
Okay, so something to keep in mind there. Now, of course, it's not just D-Wave Quantum. You also have leverage funds, one-day resets on AppLovin and Tempest AI. Can you talk us through how you decide which individual stocks to launch these ecosystems of leveraged single stock ETFs around? What does that process look like?
Yeah, well, first of all, we do a screen for volatility because that's, if you look at the past successful single stock ETFs. I mean, it's the most volatile names are the ones that are, more heavily traded and have more of the assets. And also, we sort of look at, is there a zeitgeist around some of these names? AppLovin is probably a name that not many people know about, the underlying stock, even though it's a $70 billion company, rumored to be potentially one of the bidders for TikTok, of course, so that might make it more into the mainstream. But, you can look at the volumes that the stocks are trading every day, look at the social media velocity, and you can maybe get a sense of, hey, this could make for a good single stock ETF.
Now, a lot of people say, what's the point of these? Can't you just use margin? And I'm like, well, a retail investor who wants to trade, this is just the convenience. You click a button and you've got the leverage on, right? And that's really what this is for. It's just bringing convenience to something you could have otherwise done on your own, right? Is that generally what is the value add here?
Absolutely. And also, aside from the margin requirements that you have to kind of be looking at, the options market, right? Because options are a way to get leverage. For a lot of investors, especially more self-directed on the retail side, very difficult to kind of constantly be managing your options portfolio. So it sort of solves two problems, Eric, with kind of one solution.
You mentioned AppLovin and TikTok as the potential driver for that stock. Let me ask a dumb question. What is the fundamental story here behind D-Wave Quantum?
Well, it is, from what we've seen anyway, the only quantum computing company that actually has commercial product in the market, which is why the stock went up over 50% when they reported earnings on May 8th. And so a good time for us to kind of launch this product, in front of earnings. But they're seen as one of the more, I guess, commercial quantum names. As far as I see, there are only 4 pure play quantum names out there. So there's another bit of there's a little buzz, right, around those. But D-Wave, again, seems to be the more commercial of the 4 quantum names at this point.
As you made clear, plenty of momentum behind the name as well. Matt, thank you so much. Matt Markiewicz of Tradr ETFs with QBTX. And of course, you can read about this drill down plus the latest in the ETF industry when you subscribe to Katie's weekly ETF IQ newsletter. It's at Bloomberg.com/ETF IQ newsletter. And a programming note that because of the Memorial Day holiday, we will be back not on Monday, but on Wednesday, May 28th. That does it for Bloomberg ETF IQ. I'm Scarlett Fu along with Eric Balchunas. We're looking at an S&P 500 that's marginally lower. The Dow is marginally higher, so a mixed day overall here as treasuries and the dollar come under pressure. This is Bloomberg.